Just in case my last two videos didn't drive home the point about just how dangerous it is to own commodity ETFs, or any other paper representation of a commodity for that matter, I decided to put together a quick video to put the final nail in the coffin. Let's take another look at USO, one of the most popular oil ETFs used by speculators to gain exposure to the oil price, or I should say, to gain exposure to the price of oil futures contracts. On this chart, I am plotting in red the per-share price of the USO ETF going back 10 years to April 2010. In blue, I am plotting the published spot price of West Texas Intermediate oil in dollars per barrel. Since the USO ETF had a lower starting price, it's a little difficult to tell for sure how well it actually tracks the oil price, but at first glance, it does seem to move in tandem with the price of oil. But what if an investor, or should I say speculator, were to ask, if I placed $1,000 into this exchange-traded fund, will I do as well as if I were to hypothetically be able to actually hold $1,000 worth of oil with no cost of storage? The obvious answer is no. After all, the ETF charges a 0.8% management fee per year. So each year that goes by, we would expect to forfeit about $8 in management fees to the management team for doing such a brilliant job of managing the investment. What is not considered is that USO cannot just buy and hold oil at no cost. What they do is they buy futures contracts that represent a claim on oil, and then they roll them forward as contract expiry approaches. As we've seen in my plots of the cost of structures of futures, the price goes down as contract expiry is approached. This is because long-dated futures have built into them factors such as storage costs, insurance, overhead, and a risk premium. And this cost tends to accumulate over time, and thus the longer the dated future, the higher the price tends to be. But what kind of a drag will this create on actual performance? Let's take a look. Here is the same information, but I plotted an initial investment of $1,000 in the USO ETF versus a hypothetical $1,000 invested in spot oil. Notice that the curves now diverge, and they diverge quite dramatically. After 4 years, the investor in USO didn't just underperform spot crude by 4%, as a 0.8% management fee would suggest. No, the investor underperformed by 25%. After 8 years, the investor underperformed by a full 58%. Would you buy an investment that represents crude oil if someone would tell you ahead of time that within 8 years you'd underperform the underlying commodity by more than half? Of course you wouldn't. But currently this ETF has $5 billion under management. Now, I bring this up not to pick on USO, but to highlight the hidden costs of investing in commodities via the futures market, ETFs, or any other paper contract. Even if the commodity holds its value in real terms, you'll end up a loser long term. The only way to hold commodities is to buy them and store them yourself. At least that's the only way to avoid this kind of a cost drag. How many commodities do you know of that you can do that with at a reasonable cost? I only know of a few. Just saying.